Before we begin Part 4, we invite you to take a few minutes to learn more about the software and charts Larry uses throughout the world in his seminars. Here now from Genesis Financial Data Systems, Glenn Larson.
We have gone with Larry Williams around the world, literally. We have been seminars in China, Singapore, Australia, London, Italy, you name it, we've been there and done that. A benefit from this is that we've had an excellent opportunity to have the chance to listen to many Larry Williams students, such as yourselves, ask questions about how we can improve our software to help them trade. Ask questions that they're having trouble fixing when they're trying to trade. So with that, we've taken all these suggestions, we've taken these solutions, and we have put them into this software. Now, two common themes that we often have heard when we're traveling around the world is, one, am I looking at the market the way Larry's looking at the market? And two, can you help me find these market setups quicker? Those are the questions that we've addressed, and we've tried to help you with that. So to start off with, what I like to do is take the time to start with the software, how you would look as you get it, and then go ahead and step you through as to some examples that you could be using with the software. First off, let's look at, this is how we look at the software as it comes up. What we'll do is it comes up with our general pane here. What we're looking for is where the charts are, listings and everything else. But instead of spending all my time showing you how to navigate through the software, what I'd like to do is show you some of the power of the software, the questions that a lot of the students have and how we address those questions. Okay, helping me here is Mark Shriver. He's our manager. So Mark, if you would, take off the symbols list. Now, one of the two questions that we always get is, which market should I be looking at? Trading is very much like a business. You want to save your time and your money. You don't want to be analyzing markets that are not set up. So what we're going to do is I'm going to show you a report that I think is the most powerful, that helps students come up quickly to know which markets they should be looking for. Now under here we have a section called Reports. Click on Reports. This is the thing we call Commitment of Traders Market Sentiment Reports. Now what we do here is we'll pull this up and run, and it will find out, quickly scans the markets and tells you which markets are set up. Okay? This is the report. At the top here you notice that we have a percent setup over here. If you look over here, it says Genesis setup. It has 100% bearish. We have 100% bearish, 92% bearish, and bullish. So basically what we're saying is these markets are set up to be bullish or bearish, because one of the problems are, not only do you want to know which markets are set up, but which direction. Now in addition to this, we have some other fields that can be added. We have some fields that a lot of our students have used when they attend the weekend seminars with Larry, as also his real-time seminars. So we put them in here to allow you to quickly filter, determine a market which is set up. Now at the top you notice there was British pound. It had 100% bearish setup. That means the public is 100% bullish. The commercials are 100% bearish. They're selling as much as they can. So we want to go look at that market. Now we click on British pound, the symbol. We click on it. We just shrink this down. And right here we have a chart that will have the setup on that. Now we can add the commitment of traders and public sentiment on there to take a look at that. Okay. We have some stuff in here that has the commercials on the bottom here that shows some of the things we're looking at. For example, we're talking about the commercial position and the sentiment. We see here that the commercials are selling and the public are buying. So real quickly, you know that you have a setup that you want to look at. Okay? So again, real quickly, you can look at a market, determine which market is set up, and then you're ready to go. Now let's bring up the report again. And you can quickly go through and say, okay, I also have live cattle. Click on live cattle, shrink it down, and now we have the exact same chart set up for this one. So it quickly allows students to go through and determine which market is set up. Now that answers the first question, which market should I be trading? We want you to focus on the markets that are set up, not waste your time. Now let's say, for example, we're looking at this. Another question is am I sure I'm looking at the market the same way Larry does? With the templates we just showed you, we give you a setup that has all this indicators that Larry uses and the same values and the same settings. So you don't have to worry about whether or not you're looking at the market the same way Larry does. Now, the other question people will say, well, is this software difficult to use? Am I going to mess it up if I play with it? What we do is we have a lot of, if you can know what a right mouse click is, you're probably an advanced user from a lot of our customers. When you go to make a change, we will say, do you really want to make that change? And then after you say yes, we'll come back and say, are you really sure you want to make that change? So again, we want you to feel comfortable with the software. We want you to play with it because we have had a lot of students and we know what the concerns are. Now, the other concern we have is, okay, I'm not really secure about making a trade. I haven't traded that much before. How do I trade? This is another feature we've added basically based on some of our customers' requests. We're going to go in here now and say, I want to trade. Let's go back to British pound. We'd like to set up. It was bearish. We want to sell British pound. We'll come in here and we say, let's make a trade. This is what we call our trade tracker. It actually tracks real or simulated trading accounts. Right here we say, I want to pick my account. I want to set it up. I want to make a new trade. Click on new trade. And we're going to say we want to do British pound. Okay. Okay. Now this gave us our last price of the British pound. So for example, if you're snap quoting it throughout the day, which gives you the prices throughout the day, or at the end of the day, this reflects the last price that it just had. Now it shows what it is, shows you your date, and let's enter the quantity. Let's say one contract. You can fill in your commission to reflect what it is. And then you can put a note. Now this note's important because we want you to be able to look back and say this was a British pound commercial public sentiment sell. So as you review your trade, you can remember why you made that trade, okay? Because you want to be able to have that. Click OK. Okay. Type that in. This gives you a review. It shows you that you're selling one British pound at this contract, and then it allows you to go and do that. You click OK. Now this is, and it puts it into your account. Now if it shows open here with the blue, that means that the account is still an open trade. So it's an easy way for you to keep track of it. Now as you update the data at the end of the day, it'll keep track of that for you. So as you progress, you can allow to be tracked that. Now this brings up another point that I want to point out. A lot of customers will say, well, you know, I don't want a paper trade. Paper trade doesn't reflect reality. You know, it's not the same as real money. Then usually that comes up and I say, that's true, but why do professional basketball players go shoot free throws? Or why do they always have batting practice? These guys are professionals. I mean, they do it every day. It's because they have confidence in what they will respond to. They begin to train themselves. And so even though it is paper trading, we can't overemphasize the need to practice. Trading is a difficult experience in a difficult environment, but when you take on the time to paper trade and practice your trading, we've found that people have become better at it. Because then when trading, you'll hit a point where you will have bad trades. You will go through a slump, as we say. But if you know that your system works, because you built confidence in it because you paper trade, you then tend to follow through with it. That's a big concern we have found is most students, when they start trading, they get scared, they stop, and then that's when the big market takes off and they're going, dang, I missed that move, okay? So those are the two things we would try to address real quickly are which markets to trade and how to trade it. Another request our students have is they will say, okay, I know which market to trade and I know how to trade it now, but I want to focus on, let's just say, the setup, so I really understand them really well. We've had another feature, again, another request that came from some students. This is what we call our filters. Let me bring this up. We have filters that we've written a whole bunch for you. I'll just bring up the side thing on the mark there. So we just want to show that we have a bunch here. But right here we have a bunch of Larry Williams fake outs. We have naked closes, pinch and punch. Again, some of these are from his more advanced seminars from the weekend, but we have them in here. So when you get the software, you have the stuff that's on the seminar. But this is the Larry Williams Commitment of Traders Market Setups. This shows that these are the markets that are set up for a short sell. So if you want to go through and then start scrolling through these, click on it. click on it again, you can quickly look and see that the market is set up under those conditions, so you begin to become more familiar with that type of market, which is, again, familiarity is what we want you to feel when you're studying these techniques. We want you to be comfortable with what you're doing, so when the game comes and it gets tight, you'll know how you'll respond. Another thing we've done is visually, people want to say, okay, I've been given a pattern, I'm not sure I understand what an oops is. I understand the verbiage where they say it opens below the low, and goes up below, goes above below the low, and then buy. Again, it's an oops buy. Some people are confused with that, so we said, we'll help you, we'll show you. Okay, let's get rid of this, and we're going to go in here and what we call highlight bars. We've got some things in here. And what we have done is taken these patterns that Larry teaches you and highlight the bars for you. So a red says, okay, this is an oops buy right here. Opens above the previous day's high, goes through the previous day's low, you sell at the previous day's right here. Oops buy opens below the previous day's low, goes up through the previous day low, buy at the previous day's low. So again, we put in patterns that allow you to do that. Now we have, again, more patterns that you can actually program yourself or ones we have done for you. Again, the biggest problem we have is students saying, help me. And that's the question we've tried to come up with. So those are some of the things we wanted to put to you so you can see visually. You can find out which markets to look at as far as the pattern is set up. You can also highlight bars as far as market setups. You can also say the same thing that we showed where commercials are selling, public is buying. We can also highlight those zones on the bar, or you can do the report or the filter. So again, we're giving you all the tools you need to find the conditions that Larry do. Now, here's something else that we're going to go through is called the target shooter. You got the target shooter, you get this little plastic overlay that shows where to put your exits when you get into the market. We have found, again, the students are saying, this is great, but how do I lay it on my computer? They're trying to have some trouble with that. So we put it into the software. Let me show you that. What you do is once you get into the market, you're trying to get out, this allows you to set those targets up for you. And what we allow you to do is we'll put that on the software for you. These are one of the drawing tools. This is, again, one of the biggest requests we have. Now, we have some a little fun piece of software in here, a drawing tool that I really like. We've had a lot of requests for. Another one is called the dollar trend line. Now, usually what happens is people start trading. They know I need to put a stop in here about this point, but I don't know how much money that is, or they're saying I want to risk $500. About where will that be on the chart? By taking it and drawing it on any market that you're in, we can take it and draw it to that point, and it will show you where that point will occur with, say, $500. Now, usually what happens is, give me a weekly chart on this. Here's what usually happens with this chart. Okay, squinch me up some bars. Okay, let's say what happens is inevitably I say, well, I would have sold here and I would have covered my shorts there and I would have made $29,000 or $3,000. It's usually, honey, look at how much money I would have made if I had traded. That's the bar we use, and so it's like our dream bar. But it's also good to know if you had so much of a move, how much could you expect to make? So those are some of the tools we have put in to address the common requests that our students have put in. Now, I haven't gone over a whole lot with the software, but what I wanted to do is show you some of the main problems, or the main problems that we have hopefully help students overcome. Again, the biggest problem we have found, our students are saying, I've learned a lot, I think I know, but I'm not really sure. Our technicians that we have gone to the seminars that Larry teaches so that they understand the questions when you say, I'm not sure I understand if I put up the commitment or traders report right. I'm not sure if I use the target shooter right. Our tech support is available from 6 o'clock in the morning till 8 o'clock at night, Monday through Friday. So we want you guys to get in and going. The other question is well, do you have any training? Let's bring up the contact information. We have training, online training, where our goal is, we love our customers, but most customers don't want to call us, and that's okay. So what we've done is we put in online training courses where If you go to our website here at Genesis FT, click on training. What we have is our weekly classes. We have them throughout the week, several classes throughout the week, where you can go in and have a person, hear him teach how to use the software. And you can type your questions in, so it's a real session. So if you have a question, you can type it and get an answer, as well as our normal tech support. Yes, it does come with a manual, and yes, we do help you get going. So those are some of the questions: is how hard is it? If you can right-click a mouse, you can do it. We have the manual online, we have tech support online, and we have online training and a tutorial. So we hope with that we'll get you up and going. We have the standard capability of having indicators. I think we have over 70 indicators. You can write your custom indicators. The list goes on. But the important thing is, we also want to point out, is as you start your journey through trading, we want you to start off and we can get simple and help you grow. And as you grow, the software will expand with you. For example, if you attend one of Larry's weekend seminars, we have modules that will work on top of it. If you're really going to go to his real-time seminar, which we highly recommend, that's my favorite seminar, it will expand as well to handle that. So we want you to be able to progress without having to start again and stop, get and add new software. It takes it as your core, and you add your studies to that. Again, Genesis has been here to help our customers. We have, we like to think, a great reputation where our customers and Genesis have a great relationship, because we're here to help you succeed. We're here to help you become successful traders. The joke we laugh is that nobody does Larry better than we do, because we've been with him all over the world. And believe me, we have seen any type of question you may think of when it comes to how do I do Larry. And we hope we put it in for you. So if you have any questions, feel free to contact us. We'll be glad to help you if we can. Again, the other question is, do I need the software? No, you can do it by hand. But it's just like a case where when I was in college one time, I was going to save money, and I was going to change my own brakes. And I remember spending half a day trying to change one brake pad, and I had my friend come over and he goes, "Oh, you just have the wrong tool." He walked out there, and I'll be dang, 15 minutes later we had the second brake set changed. That's the same thing we're offering you. You can do it, but we promise we will get you where you'll be better off and make more progress quicker. Thank you for your time.
In this fourth and final segment, Larry brings it all together. He'll show you entry and exit techniques, and most importantly, help you get ready to start trading. Here's Larry.
Welcome back. This is the last tape in the series. In this tape, we're going to get into specific entry techniques. We've looked so far at what makes markets get set up for major moves. Let's look at what those setup criteria are, because it starts with setups, and then it gets to entry. Most people want to get into entry. Don't have a clue if it's going to go up or down. They just want to trade. They want to buy or sell. Don't want to do that. The setup tools that we have are, first of all, the commercials. We want to look at what the commercials are doing. And we can look at the commercials, remember, in a couple of different fashions. The first way we can look at the commercials is the COT report. That's their actual buying and selling. That's their buying and selling. The second way we can look at them is, there a premium in the marketplace? Have they bid a market to a premium? Third, we can look at the open interest play. The next thing we want to look at are the investment advisors. Remember, those people are wrong most of the time. We want to do the opposite of them. So we'll look at the advisors. The advisors, when they're greater than 90% bullish, equals a market top. When they're 20%, only 20% bullish, equals a market low. The ideal thing is to have these guys in opposition. The commercial's really bullish and the advisor's really bearish. That's the juxtaposition of the two. That's the ideal thing. Then we can also bring in a seasonal tendency to see what the seasonal pattern is at this time. There's a seasonal call for an up market in here. There's a call for down market in here. We want to look at that to see what the condition of the marketplace is in terms of the seasonal tendency in the market. That helps us say, okay, this market's set up. We know what the wisest, largest money is doing. We know what the most uninformed money is doing, and we're doing it at the right time, at the right place. Now it's just a question of getting our position entered into the marketplace. Where do we buy and where do we sell? There's a lot of ways of looking at that, but before we get into the specific buys and sells, you have to know about order placement. What do you tell your broker? Just buy? No, we have specific orders that are rules and words of the exchange. This is official language. We buy on a stop order, buy on a stop, which means this. If price is trading at 60 cents and you tell your broker you want to buy at 62 cents on a stop, price must rally up to 62 cents and there'll be a buyer there. If you think the market is going to go down and then go up, you think it's going to go down to 57 cents, you're going to buy on a limit. So prices must move to a limit order. They must go down. That's limit or better is buying below the market. This is the market. Buying below it is the limit. Buying on strength above it is buying on a stop. My preference order is to buy on a stop. I like the market to prove itself. I like somebody else's money to rally the market to where I want to become a buyer. I want to get aboard a freight train when the momentum is there, not when it's going in the opposite direction, hoping it'll turn around and go in my direction. So my orders most of the time are buying on a stop. I want the market to move from that opening price and then start to move up above. And I like to buy strength in the marketplace as opposed to buying weakness, because I found a lot of times when I buy weakness, it gets weaker. I want to be going with the current rush of the marketplace. So I tend to be buying on a stop. Now, once you get into the market, now you're long or you're short. Let's say we're long, the market's come down and started to rally up. Now, if we want to sell, let's say we're long from here at 62 cents, and we want to sell at 67 cents or better. That's a limit order above the market. I want the market to run to that price. If it gets there, just trades there, then my orders will go to the floor and become an effective order. By the same token, since the market might not get there, it's trading here right now, I need some protection below the market. What if the market doesn't get to where I want it to go and it just crashes? So I need a protective stop under the market. So I have a stop now under the market. Initially, my stop tends to be here. I bought here. My stop is below the low that I bought off of. As the market starts to move up, I start to raise up my stop until I either hit my trailing stop and I'm stopped out, or it goes to my target. But the orders placements we'll use will be buying on a stop or selling on a stop to get in most of the time, and then a limit order to get out. And the other side is to have a protective stop. So many people think that somebody's going for their stop, that this is a rigged business, that the market moves to your stops and you get filled. Could be. I don't know. But I'll tell you this, you've got to use stops. If you don't use stops, you will get beat up in this marketplace, because what will happen, you let a small loss get a little bigger, and suddenly it's out of control. Now you've lost a whole lot of money when you could have lost just a little bit of money. The first loss you take, the smallest loss you take, is a lot better. It's kind of like that old adage the guy said, if I would have shot my wife the first time I thought about it, I'd be out of prison by now. And you women can change that around, okay? But it's exactly what it is. I mean, once you're wrong, acknowledge it, get out of the deal, and move on with your life. And it's really important you do that. Most people let little losses turn into large losses, and they take small profits. You'll be so happy you got a profit. You'll take a little profit and a big loss, and guess what? That's not good math. So you have to limit your losses. Now, your losses, you need to give the market some room in there to breathe, because the markets they're not totally predictable. They'll oscillate around back and forth. I like to use a protective stop if I'm in the market, depending on the market, of just $1 stop. I don't want to lose more than $1,000 in most markets. In the grain markets, about $800. I can't lose any more than that. That's as much as a loss as I want. Or you could use 90% of the average range of the last 3 days. Subtracted from today's low if you're long, plus today's high if short. That's a pretty good operating rule. That way, if the market's really volatile, that 90% of the average range will be bigger. If the market's not volatile, then you'll be a little closer to the market. So we let the market tell us where the stop should be, not us guessing where the stop should be. And I always place orders in the market. I was trading today. The market's closed now. I was trading the S&Ps today. There were stops in on every single trade. There's always stops in on every single trade I have because I've had too many instances, especially when I was young. I didn't use a stop, and then the market gets down so much against you that you can't do anything. The only place you really find religious people seems to be like casinos and commodity pits, because people get really religious about these positions, and that doesn't work. You just have to deal with reality, and the reality is you need stops. If you don't use stops, one little loss is all that it takes to wipe you out. So it'll get so big you can never come back. So stops, don't worry. If the market's rigged, they're going for your stops. Doesn't matter if they are or if they're not. It's our only protecting mechanism, so we want to use stops. If you have questions about order placement, you should definitely contact your brokerage firm. They have little books that explain all this in more detail, as they'll explain margin requirement and contract specifications for you. Call up any broker, they'll gladly send that out to you, but make certain you understand your orders. Also, when you call your broker, even at my old age in doing this, occasionally I've been known to call my broker up and say sell, and he'll say, "You mean buy, don't you?" And I say, "Yeah, I did mean buy. How do you know that?" You just get so carried away with this sometimes, or you're thinking one thing, and just be careful what you say. That's why I like to have a relationship where my broker's been godparents of my kids. I've been my brokers for a long time period. A lot of people do orders electronically now, and there's a place for that, but I'm no computer whiz and don't type very well. I'm afraid I want to hit 2 instead of 2,000 or something, and I get the wrong order. Who knows what's going to happen, but especially starting, I think you're probably going to need a broker to hold your hand and walk you through these trades and explain to you exactly what you're doing, so you know what's doing. The other thing that always interests me when people say, "Oh, the market's rigged, the guy's on the floor running the market or whatever," it's not unusual for me to have somebody call from the floor and say, "What's going on down here? What are we doing today?" I'm going to ask them what's going on down there, right? But they're asking me. So there's no one that seems to have the be-all, end-all market truth. Whether you're on the floor, off the floor. The largest bond trader in the history of the world was a friend of mine, and we were trading one time together off floor, and he's pointing at me and saying, "Hey, you're rigging the market." And I'm saying, "No, you're rigging the market. You're the big trader." So nobody is right all the time in this business. Nobody ever will be. You won't be. I won't be. You just have to get used to getting beaten up. It means protect yourself with stops. You got to have protection. Okay, well, once we have stops in place, then we can look for different ways to get into the marketplace, different entry techniques that we can use. And I'm going to talk about some real simple entry techniques we can use. Probably the simplest one is a system that was developed by a fellow by the name of Richard Dennis. Richard was a money manager, depending on who you read or believe. He took $200 and ran it up to a couple $100 million with something called the Turtle Trading System. Well, I bought the rights to the Turtle Trading System from a turtle trader. Dennis had gathered together 10, 15 people and taught them his system, and then they went out and started trading the markets. Last year, 2002, I believe the Turtles made over $100 million with their version of the Turtle Trading System. So I'm going to teach you right now what the Turtle Trading System is. You don't have to pay any money for it at all. It's a real simple system. What Dennis said was this. We're going to buy a commodity at the highest high of the last 20 days. And our stop will be the lowest low of the last 10 days. And when we want to sell short, we'll sell at the lowest low of the last 20 days, and our stop is the highest high of the last 10 days. That's the short-term version of the Turtle Trading System. That's all there is to it. That's it. So if the market's been going like this, and you say, okay, the highest high of the last 20 days is here, you'd have an order to be a buyer there at the highest high of the last 20 days. So the market goes up there, you're now long. If the market immediately comes and reverses, we go to the lowest low of the last 20 days and you'd sell short. We'll actually look at some examples thanks to the Genesis software. Mark's going to put a 20-day channel on there. I think Dick Donchin was the first one to use these channels. Dick died a few years ago. He was a friend of mine, first guy to have a commodity mutual fund. Notice the red line is a 20-day high, so if you buy at the 20-day high, you stay long until you get to the 20-day low. At that point, you would be short, and now you would reverse at this point at the 20-day high. So it just follows the market with the highest high of the last 20 days, lowest low of the last 20 days. It looks great in this example, but when Mark squinches the bars up for us a little bit, we'll see lots of times things like this happen. You sell here and buy here and sell here and buy here and sell here and buy here, and then you finally get a winning move. As Dennis taught the turtles, the system is incorrect about 60% of the time. Most people can't live with that. Most people I lecture with can't live with that. The only way it works is to have a large basket of commodities and a lot of money, maybe $200,000-$300,000, because eventually some market will have a big trend move. We just don't know which one. That's the turtle theory. It's almost like playing roulette. You put a chip on every number, you're going to get paid 35 to 1 on one of your trades. You just don't know which one it's going to be. So to alleviate that problem, what I've done is look at it a little differently, and that's to say, look, we're smarter than turtles. We know one thing. We know when a market's set up to move. We have a really good idea that the market's set up because the commercials are long, the public is short, the seasonal tendency is at the right time. The large traders we saw earlier, they've been on the other side of the market than the commercials. Now it's time for us to take action. And we don't need a 20-day breakout to be a buyer. All we have to do is be a buyer at the highest high in a setup market of the last 8 days or the last 12 days. Take your choice. I like 12 days. So I'll buy a 12-day high if, and this is the big thing, this market's set up. If it's not set up, it doesn't matter because the condition is the setup. I'm not a technical trader. I'm not a fundamental trader. I'm a conditional trader. That's what I like you to be. Hey, I got the condition here. Now I can bring in the channel breakout to the highest high of the last 12 days if the market's set up to be a buy. If I want to sell, the market's set up to sell short because the commercials, et cetera, I'll sell at the lowest low of the last 12 days, 12-day low. And that's where my sell point is in the marketplace. As an example, I got set up to be a seller in gold. We saw that on tape 1 at the first of the year. Now the question was, when do we want to take action? Remember, the commercials got short a little bit early in the gold market, if you recall, and gold continued rallying. It doesn't matter in terms of our trend position because while the commercials got short in here, the 12-bar low clicked off here. So we can rally for quite a while. When the trend changes, now we can sell short and take your profit either at a target or we want to cover our shorts down here. We've hit the 12-bar high and the market started to get set up down there to be a buy signal as well. So it works by first the market getting set up, then taking the buy signal, only the buys because the market's on the long side. When it gets set up to be a seller, then sell at the 12-bar low and let this be our protective stop as it comes on down. So we can ride the trend of the market, but only when the market's set up, only when that condition exists for us to be a buyer. Without the condition, the turtle trading technique and channel breakout technique is not going to work for you. You have to have the condition there, then you can take entry into the condition. That's the critical thing. And then it's pretty simple. Just look at the highest high of the last, you want to buy long down here, the market got set up. Look at the highest high of the last 12 days, there it was right there, boom, market goes to it. You have an order resting in the market to buy on a stop at that price. A market that's been getting set up recently is sugar. We take a look at sugar, it's been set up by the commercials and by the advisors, and there's a little seasonal tendency coming in here. But there's the 12-bar high, it just started to get set up, so there's our 12-bar trend change right up there. So until we get there, we don't have to worry about it. If it gets there, then we want to be a buyer of the market. It was set up to be a seller up here. There's your sell signal in the market. That's my trend entry. Now, there's a lot of other entry techniques you may learn yourself, trend lines, lots of other entry techniques that you can use, but this is the simplest one. It's real easy. It doesn't take a computer to do it, and it will help you ride the trends in the marketplace. Once you get into that trend move, you need to know where to take your profit in the marketplace. So let me show you how I'd like to take profits. This idea was originated not by me, I wish I would have come up with it, but by a market analyst in the 1940s, two actually by the name of Owen Gartley, but primarily George Siemens. What Mr. Siemens' point was that a market is like a metronome on those metronomes, the piano players, have you seen those that go tick this way and tick that way and tick this way and tick that way? He said if a market has come down and rallies up, if it rallied, say, 17 points above this point, it will then decline the exact same distance below that point, 17 points below it. And that's where George Siemens said we should probably take our profit. Sometimes we'll go right through there. Sometimes we won't go down that far. That's why if it doesn't go down, we still need to have a trailing stop. But that's been a pretty good place for me over the years to say, let's take our profits. We had a good example this year in the silver market, where silver put in a significant high. The commercials got short. We got a trend break in the marketplace. And I'll show you what happened in that market as we started to break to the downside of the marketplace. The market had a nice run up in here, made a new high. If we take this distance from here to here, and Mark will put what Genesis calls a target shooter on it, we should decline this amount from this high to this low. We should decline that amount below that low, right there. That's right where the market bottomed and started an intermediate term trend, and that's where I covered shorts in my advisory service, right there. The day of the low in this case. Really just very, very lucky for us that that's where the market bottomed out. Now the next possible trade is from here to here. So we'll delete that and say, okay, we took out this low, we should trade down to target. Well, this hit the first target, but it didn't hit the second target. So the trailing stop gets kicked in here. If you don't get to a target, you still need a trailing stop in the marketplace. I love the idea of taking profits at targets. That's a great place where you want to take your profits. I think we probably had one over here, Mark. We go from here to here, and you see that's where the market went to the upside and hit the target right there. Boom, boom, and that's the top of the marketplace. So what I'm using to do that with are the intermediate term swings in the market. Remember, on I think the last tape we talked about how we could identify intermediate term trends in the marketplace. We don't want to use just these little squiggles in the market like this. We want, that's an intermediate term high, lower highs on both sides, intermediate term low down here. When this low gets broken to the downside, that's the measurement we take. If you're lost at all, you ever wonder, just take the large swings in the market, a swing of 10, 15, 20 days. Take that swing, we fall below that low, you want to be a buyer of it. By the same token, if we get above this intermediate term high and we come down like that, you're going to add this amount to this amount, and that's going to be your target where you're going to take your profits in it. In your video course at home, you actually have a transparent overlay. You can just put that right on top of your chart, and I'll show you how that works, and I'll do that with two different colors here. What you want to do, it'll work on any chart that we have where the scales are equal. And if the price has been going like this, starts to come down. Once this point is broken, we can say, let's look for our target. So you take your target shooter, you have three lines on it, like so, and this is the target line, or line number 3, or target, it should say. So you put the high on the first angle line, this comes across the low point, this horizontal line, and draw a line straight down. Where that touches, that's your target. That's how you use your target shooter, and the instructions are in the manual as well. But again, so you just visually see what's going on. You put the target line below, and then you squinch up these lines until the top line fits the high line, and the horizontal line fits this low, and that's where your target is going to be in the marketplace. Real simple again also. This distance subtracted gives you the low. If you want to do it another way, it might be simple for some people to do it that way. That's where the target is. And I don't have any problem at all taking profits at targets, because since I'm trading for an intermediate term move, I'm trading for a significant amount of money here. I'm not taking a day trade or a little tiny little move in the marketplace. This usually is a substantial amount of money in the market. So my wins tend to be larger than my losses because I'm trading for a decent amount of money. Hopefully I'm selling short here or here, and I'm trading for a pretty good size move in the marketplace. So that's the target shooter. There are a couple of other entry techniques that I like to use to get us in the market. But again, it all starts with the setup markets. Let me show you one of the patterns. This is one I'm probably the most familiar with. I showed you the fake out pattern earlier. I'd now like to show you the oops pattern. The oops pattern works like this. Here's a day's action. This is the high, this is the low, and this is the close. Tomorrow the market has maybe some big news comes out. The Russian did something, the German did something, we did something, whatever. The market gaps way down here. It opens below yesterday's low. That in itself may be bearish. However, if it starts to rally back to today's low, I want to be a buyer there. That's my buy point. I want a condition to be there. I don't want to just take it just because we opened below yesterday's low, though when we look at examples, you'll be amazed at how many of them work just on their own. But I want it to open below the prior day's low, come back to the prior day's low, at which point I'm a buyer. A sell signal is just the opposite. I want the market to open above the prior day's high. It may run straight up. I'm never short. But if it comes back to the prior day's high, then I'm going to sell short there. That's my sell point. What's happened, whenever a market has a big gap up like that, there are only two possibilities. Markets just don't gap up there and stay there all day long. Just like look around, like go up or go down. It never happens. They're either going to continue that gap to the upside, or they're going to go whew, and crash. So that's what I'm taking advantage of. A big gap will either continue in the direction of the gap or it will fail. This is the failure of the gap. I call this oops. Because what usually happens is as the market opens lower down here, the broker calls the customer and says, wow, there's some really bad news out. So the customer says, oh, let's sell them on the opening. Just sell them. So he sells on the opening, prices come down, they start to come back here. Broker calls them back and says, whoa, market's coming back now. And the customer says, oops, we did the wrong thing again. And now they buy back. Well, they don't hear about this until here. I've already bought here. They hear about it in here, decide they should do something about it here, and then the market really starts to move. That's the oops phenomenon. And with that, I'll look at some oops signals we've seen in the marketplace. Mark's got a couple there. That happened to be silver. So we'll just look at silver with the chart we had on. Notice what happened at the high that we had, a traditional oops sell signal where we opened above the prior bar's high. This is the high, and this horizontal line is the opening. We opened above it, came back to it, and there's the crash in the marketplace. As a short-term trader, I like to get out on the first profitable opening, which would be here. Here's another oops where we opened above the prior day's high, came back to the prior day's high, and I'm out on the first profitable opening. Here's another day where we open below the prior bar's low, come back to the prior bar's low, and I get out on the first profitable opening. Another day where I open above the prior bar's high, sell at the prior bar's high, get out on the first profitable opening. If it's a little one, maybe held on to here. In that case, we had 1, 2, 3, 4. All 4 of those signals worked. Let's come up to current time mark and see what's been going on in the market. Here's an oops signal that didn't work. We opened below the prior bar's low, and we didn't get a first profitable opening. Same thing here. We didn't get a first profitable opening. That's why I don't take every single one of them. I want the market to be conditionally set up. I'll show one that was set up. In the case of gold this year, in March of this year, the commercials, 2003, the commercials become heavy buyers in the marketplace. And a lot of stuff I had said, hey, gold's ready to rally. And I'm not a big gold bug. To me, gold's another commodity. I'm not a gold bug guy at all. But I noticed I had an opening below the prior bar's low, and I bought as we rallied back to that prior bar's low because the condition was there. The advisors were really bearish. Mark, can we put the advisors on there? The advisors were bearish. The commercials were really bullish on the market. The seasonal tendency was starting to come into the marketplace. So you know what? This looks like I want to be a buyer. And a real short-term buy signal came into effect in the marketplace. The commercials are the Mark. Let's go to a weekly chart on that. First of all, we'll see what week that was. The advisor, the red line is the commercials. They'd come up and were big buyers in here after not being buyers after selling up here. And the sentiment index, the advisors were now negative on the market. It opened on that Monday, rallied back to the prior week's low as well as the prior day's low, and that's where I bought it. And we had a move of about $5,000 per contract off of that move in the marketplace. Typical example of an oops trade. On a daily chart, here it appears here on a weekly chart as well. Weekly oops are also good. I actually have 4 ways I trade this oops formation. The first one is the easiest one to learn, the original oops, what you just saw. I'll show you a couple that happen in the S&Ps, a market I trade a lot, and we'll go to the S&Ps on a daily basis, Mark. Go back, last summer I think we had Well, there's an oops signal. I took this oops signal in Australia. We opened above the prior day's high, sell at the prior day's high out on the first profitable opening. Opened above the prior day's high, sell here out on the first profitable opening. And we had another one just recently. Opened above the prior day's high, sell at the high out on the first profitable opening. Go back to the low last year, Mark, and we can look at a couple. There's the low in March. Go back to there's how we bottomed in March. We opened below the prior day's low, came back to the prior day's low, and away went the marketplace. That's the oops phenomenon. One of the better oops I'd like to illustrate to you, the mother of all oops in the S&Ps, took place of October 97, I think, Mark. We'll take a look at that, and this is a really interesting story. And it's a sad story, and it's a wonderful story. You've all learned oops. I've taught this all over the world to thousands and thousands of people. I got a call from a lady on this day. She had called and said, basically, I'm in a world of hurt. I said, really, what's going on? She said, well, we sold the S&Ps this morning. I said, you sold them? Why did you sell them? We opened below the prior day's low, and we came back to the prior day's low. She said, well, over the weekend, my husband and I fasted and prayed, and we thought this was the big crash of all time. I said, well, I always taught you to use stops, though, didn't I? She said, yep, you did teach us that, but we didn't use them. I said, oh, well, what did you do? She said, well, we actually sold some more up here. We sold some on the opening, we sold some down here, and we didn't think that oops sell signal would work, so we sold some there as well, and we sold another one up here. I said, you mean you're short 4 S&Ps? She said, that's correct. So her average price is around the opening price, and so selling short on the opening and getting out on the next day's opening price, let's Mark just run those numbers up. This is when the contract was half the size it is now, so you have to double the number that you're going to see here. That was $16,000, double that, $32,000 swing on 4 contracts. But she was short. She and her husband were short the market. They lost that much money. And I said, well, you have to meet your margin call. And she said, well, that's the real problem. We don't have any money. So how did your broker let you trade? Well, we told them we'd wire funds, but we don't have funds. Boy, this is tough business. I said, do you have a mortgage on your house? She said, yeah, we have some equity on our house. I said, not anymore. And they ended up losing their house to the brokerage firm. This is a cruel business. This is real money. This is not a game. But the reason that they lost was they had a belief system. They had a belief system the market was going to crash. You can have a belief system, but you need protection because your belief could be wrong. They defied a basic oops signal, said buy here, it made $16,000 or $30,000 per contract. But they defied reality of, hey, there's a buy signal, and they didn't use a stop. And that's what killed me as a young trader, and I've seen it time and time again. You believe something will happen, and if you believe it's going to happen, you don't use a stop. My most empowering belief isn't that I'm any good, because I'm no good as a trader. My most empowering belief is that the next trade is going to be a disaster, that I'll lose on the next trade. Because if that's my belief system, do I use stops? You bet. Do I overtrade? Nah, not if I believe it's going to be a loser. I'd mortgage a house and buy the farm, if you will, when I thought I was right. So finally I learned, hey, believe that it ain't going to work. That's the most empowering belief system in the world. A few years ago, I got to know Tony Robbins. I don't know if anybody knows Tony Robbins is, a big, tall, motivating type of speaker. Tony and I were sitting around one day. He said, boy, I'll make you so optimistic and so positive about what you do. And I said, hey, I trade pork bellies. I don't want to be positive about what I do. Not in the least bit, Tony. I don't want to be positive about this stuff. He said, what? Everybody wants to be positive? I said, not me. Not in what I do. I'm a speculator. I'm scared to death of this stuff. Because of stories like friends committing suicide, people losing a house. Sad story. They had a belief system and they didn't follow the laws of the marketplace. That's how that stuff happens. That's why people end up in such troubles in the marketplace. So keep that in mind, but also keep in mind oops, because oops has had some wonderful signals. Mark, go to the high in 1999, 2000, the whole bear market started. And you'll see how the bear market started. There it is, oops signal. We opened above the prior day's high, and that started the entire bear market. This oops pattern has been a wonderful pattern. It's interesting to see. Again, it's one of these things that works around the world. Doesn't matter what country I'm in. We see oops signals time after time after time. If there's anybody, if there's a market you'd like to look at, we'll look at anybody, call out any market you want to. Works in stocks as well. And you'll see the oops pattern is a very effective pattern. Something you want to see it in? Okay. Let's see if we can see some more oops sell signals. There's an oops signal opening above the prior day's high, sell short. This one is opening below the prior bar's low. Buy there, get out on the first profitable opening. Another one opening above the prior bar's high, sell short there, out on the first profitable opening. Open above the prior bar's high, sell short there, and down the market goes. Great psychological phenomena. On a short-term basis, real short-term stuff, the market moves on psychology. And what you need to do is realize that these charts influence people. And people look, oh, that looks so bad, which means to us it looks good. And those markets gapping up like that and collapsing, that's the message that we want to get with the collapse. The short-term looking at charts is about human psychology, about how people respond to things. There's no magic to the oops pattern. It's pure human psychology. Well, let's look at a couple of other ways we can get into the market. One that I developed many years ago is my percent R. Percent R is a good little tool that will tell us when the market is overbought or oversold. Percent R is similar to another indicator called stochastics that a fellow by the name of Ralph Dyson, not George Lane, developed. What I looked at back then was the range of the last X number of days. We're going to use 14 days as an example today. So I take the highest high of the last 14 days and the lowest low of the last 14 days and today's close. Let's say that the lowest low of the last 14 days is 10, the highest high is 20, and today we closed at 18. I will subtract the high from the low, which gives me 10, and divide that into the close minus the low, which is 8. If I divide 10 into 8, that gives me the percentage of where today's range is, where today's close is within the range of the last 14 days. What I noticed back in 1966 was that if we're way up in that range, we're probably close to a high in the marketplace. If we're way down in that range, we're probably close to a sell in the marketplace. We're close to a low in the marketplace. If we're low in that range, we're oversold and the market's probably going to rally. If it's high, the market's overbought and we're probably going to come down. We'll look at some examples, and percent R is in virtually all the software. Every software you have will have Williams percent R in there, and the Williams accumulation is also in a lot of the software. There's the accumulation stuff I went over. So we'll look at an example. Mark's brought an example on the board here. We've got the S&Ps, but it doesn't matter. It works on whatever market we want to apply it to. And we see that, sure enough, when we get this level at a real high reading, the market starts to come down, and at low readings, we tend to have rallies in the market point. However, the best way of using percent R is in conjunction with the overall trend. It's so significant. I don't like to take buy signals in a downtrend. I want to take buy signals in an uptrend. So when this trend is clearly up, and you could use maybe the turtle trading technique that we're above the high, the low of the last 12 days, we're above the low channel, then the trend's up. And you want to take all the pullbacks that percent R develops in here, and it looks like we're getting close to another one over here. Trend's up in here, we want to be a buyer in there. Still up over here, oh, that one doesn't work out. But I want to be in phase with the trend. Actually, a 50-day moving average is a pretty good indication of the trend. Mark, let's put wheat with a 50-day moving average and percent R. Now, 50-day moving average is simply the closing price of the last 50 days. It would be similar to a 10-week moving average if you wanted to use weekly charts. And when the 50-week moving average is an uptrend, only then do I take the buy signals. If it's in a downtrend, no buy signals, I only take the sell signals. It's a very effective trading technique. So the 50-day moving average is down, so I want to be a seller here, a seller here, a seller here. Uh-oh, it turns up. Can't take the sell. Now I want to take the buy because we're now above the 50-day moving average, which is in an uptrend. We've just got another buy signal coming. Trend is up in wheat, and we're above the 50-day moving average. Its trend is up, and percent R is dipped into the buy zone. Go back a little bit in time, Mark, and we can look at the other side of that. And now the trend is up. We're above the 50-day average. Its trend is up. We want to be a buyer here, want to be a buyer here, want to be a buyer here. It doesn't work. The next one's set of them over here work because the trend is still up. The trend, there's an old saying that the trend is your friend, and it is until the end. That's a problem. Nobody knows when the trend ends. But I will tell you this, we know this about trend. once trend has changed, the first couple of pullbacks are pretty good buying opportunities. The later you stay in the game, the worse the buying opportunity becomes because you're overstaying your position. You don't want to do this forever because one of these is going to be when a market's topping out. But the first couple after trend has changed has been a very effective technique to get into the marketplace. So I like percent R to say the market's oversold on one time frame, but on a longer term time frame, the market is in an uptrend. It's a strong uptrending market, and I'm just buying pullbacks against that uptrending market. That's how I use percent R. The ideal thing would be the market gets set up in this zone, then we get trend change in our first pullback after our commercial setup, after the advisory setup, after the sentiment indicator setup. All that stuff's there. We have a nice rally. We can buy the first break in the market, the first dip, and we'll know that when percent R dips into that buy zone somewhere below 25%. That's the ideal trade to take. The setup's there, the trend change is there, and we've had our first pullback into the marketplace. Percent R tells it we're ready to be a buyer in the marketplace. Simple as that. Any questions on percent R or use of it?
Does it matter whether the bars go below the 50-day moving average?
It doesn't matter if the bars go below the 50-day moving average. If they close a couple, 3 bars below, it definitely does. But if we just get back to it, the 50-day moving average is still in an uptrend. I'm interested in taking a buy signal here, especially if I haven't been in this trend for, this is 3-4 months in the trend. If I'm in the trend a couple of months, those are your best ones. I don't want to overstay my position. The first couple pullbacks are the best pullbacks, regardless of the trend time period, whether it's a short-term trend or a longer-term trend. The first ones are going to be your best ones, always. As long as we're on this, there's one thing I'd like to touch about, which I haven't talked about yet, and that's option trading. A lot of people don't want to put up too much money, so they want to buy options on commodities instead of plunking down money and being a margin buyer or a futures contract buyer. There's some disadvantages and some advantages to it. I'll show you what I've done. We'll take a look at soybeans with the sentiment index, if you would, Mark, and we might as well put the commercials on there as well. The option market is really interesting because it allows you to put down a very little money, maybe like $150, $200, and control a contract of soybeans that would usually cost maybe $1,100 for $800 for the margin. You get the most bang for the buck with options. The problem with buying options, though, is they're a depreciating asset. They're expiring all the time. The premium you paid for that option is always eroding. That's the problem. And it's hard to beat that game. The other number that's always stuck with my mind is about 87, almost 90% of options expire worthless or below the premium that was paid for them. So you're going to lose on 9 out of 10 trades if you're an option buyer. That's not good odds. The advantage to that, though, is what people say, well, you can only lose what you put up when you buy an option. That's right. You can only lose your $300 9 times out of 10. So that's not real good either. What I actually like to be a writer of options, or if you're going to be a buyer of an option, what you want to do is be a buyer when the commercials are heavily long the market and the advisory sentiment guys are very negative on the market. That's when you want to buy your option. And only then do you want to buy your option. That's the ideal option trade. Then the commercials get heavily bearish on the market, and finally the advisors get really bullish on the market. Now we want to write an option, write a put, or sell calls if you're a seller. Then you have to wait and wait. Oh, finally they get in the juxtaposition again. The commercials are finally really bullish, and the advisors are really bearish. Good. Now you can buy your option. But you start trying to buy options along here, you're going to lose 9 out of 10 trades. It's just going to happen to you. So if you want to come in with the smallest amount of money, $300, $400, a couple $100, and be an option buyer, that's the best strategy that I know of. Make certain that the advisory sentiment guys are totally negative and the commercials are totally positive. And even then, I'd still put the trend of the market on top of it. What's the trend of the market been? If the trend is up, only then do I want to be a buyer. If the trend is down, only then do I want to be a seller. So difficult to play a game where the odds are 9-1 against you that I want to have as an option buyer commercials, advisory sentiment, and the trend in my favor. The trend must be up to be a buyer. It must be down to be a seller, a buyer of puts. It must be up to be a buyer of calls. That's the best option strategy that I know of. There's a lot of other good option work done by Larry McMillan, a friend of mine. George Fontanellis has also done work. If you want to get into the option market, that's a real specialized area. I would suggest you read some of their work, or maybe somebody else, but I'm not an option expert. I know when to get in a market, when to get out of a market. Options is a whole different strategy to the marketplace. But like a lot of this stuff, be careful, because of 9-to-1 odds against you winning on any given trade. Timing is critical to just buying outright option position in the marketplace. Please.
There's people in the room here, I think, that are producers, wheat producers, and if they saw a $5 wheat and sold their wheat and thought, well, I could go to 70 by the call. I mean, is that a viable?
I think, to me, the viable strategy, the question about producers of wheat or whatever the commodity is, I think the viable strategy as a producer is this, is you producers, stop trying to speculate. Every producer I know has lost money. Say, well, yeah, my crop did pretty well, but I lost it all trading pork bellies or something. They get way off track. You know what your crop costs you to produce it. You know where you got a profit. If you can sell some of that at that profit, sell it. You lock down that profit and let the market run. But now if you sell it all at this price, you're going to buy a call because you think wheat will go higher. Probably if you buy a call, it'll go lower, first of all. And secondly, just you know what your cost is. So let's use the futures market to take down profits. You don't want to sell all of your crop because you may not produce it. Who knows, you're going to get a hailstorm or what's going to happen. But you want to say, okay, at this price I'm making money, so I can sell some of my crop there, and at a higher price I can sell some here, and I'm happy to take those profits. Most farmers and ranchers are just like human nature itself. We're all too greedy. So they wait, and the price never goes to where they want to go. So if I was a producer, I'd say, hey, I can make money at this price. I'm happy to sell part of my crop there, a large part of my crop there, because I'm making money at it, for sure. That's a strategy that I would do, as opposed to try to take it to that next level and get sophisticated about it. I'm not a very sophisticated trader, so I don't know how to do it. Maybe somebody else does, but I've looked a lot. I haven't seen anybody that knows how to do it consistently all the time, that's for sure. So I just say, hey, use the market to take your profits from your production. That's what a commercial should do. That's what the marketplace is for. That's the other point that needs to be made. These markets were not set up for speculators, for we the people. These markets were set up for the commercials. You always have to keep that in mind. They allow us to trade because we provide liquidity. We bring liquidity into the marketplace because a lot of us to offset their position. But the markets are for the commercials. It's a commercial functioning market, and you just need to remember that. That's why the commercials are so important, and it's a hedging purpose. That's what they do. The big guys that are the most successful at it, that's what they do. So that's the way I would use the markets myself. Okay, let's see what else we need to go over. In your book, there are also some S&P pattern trades. I trade the S&Ps a lot for this reason. As a short-term trader, it's a very active market. I get my most bang for my buck trading the S&Ps. It's not unusual for me to make $20,000 to $30,000, $40,000 a day in an S&P position, buying today and getting out in a day or two. I've had 2 trades like that this week. That's not an unusual event. It happens. Sometimes we'll have losing trades too of that same magnitude, but the majority have been winning trades. And I'm going to talk a little bit about how I short-term trade. How I short-term trade the S&Ps is just the same way I was short-term trading soybeans. When I first started trading as a short-term trader, that was the big market, soybeans and pork bellies, and I still have a bit of an addiction to pork bellies. I still like to trade bellies. Every dirty trick in the book has been pulled in the pork belly charts. So if you want to learn anything about technical analysis, go look at a chart of pork bellies. All the secrets of the game are there. The only thing is the liquidity and the volatility dried up in soybeans, and now it's in S&Ps. As a short-term trader, I have to be in the most volatile market where I need the biggest bang for my buck, where these wild markets are, and currently, could change, but currently that's the S&P 500. So as an S&P trader, my average length of trade is about a day and a half, and I average about maybe 2 trades per week. That's all. it kind of surprises people when I talk about short-term trading. A couple of trades a week for me. I mean, I'd like to trade every day because I like to do this stuff too. But that averages out about 2 trades a week, 1.75 trades, something like that. And a lot of the patterns I trade are right there in the book at home for you. Now, there's some really interesting things that go on with the S&P market I'd like to talk with you about. As an example, we looked at the OOPS signal in the marketplace, where a market opened below the prior day's low and then rallies back to that prior day's low. That's a basic OOPS buy signal. And you'll see that in the patterns. I think there's about 12 patterns in your book you can trade with. I trade those patterns myself. However, this is a significant thing. I've been talking for 4 hours with you people now, and the videos at home, and every single videotape you have, I've talked about it's a condition that matters. Well, even as a short-term trader, it's the condition that matters. As a short-term trader, there's a fundamental condition that's bullish for the S&Ps or the stock market, and there's a fundamental condition that's bearish for the stock market. Basically what it is this. If I want to be a buyer in the stock market on a short-term basis especially, I want bonds to be in an uptrend. In other words, lower interest rates. When bond prices rally, that means we have lower interest rates, an inverse relationship. So as a fundamental short-term trader, I want to know what bonds have been doing. It doesn't matter what signal you look at, any signal you come up with yourself, if you go on the computer and run these numbers, you'll see that anything works better, makes more money, accuracy is higher, risk-reward ratios are better, average profit per trade is higher if bonds are in an uptrend. Generally speaking, if bonds are greater than 18 days ago, the close 18 days ago, all those buy signals will work better. By the same token, if bonds are in a downtrend, i.e. we've been having higher interest rates, then the sell signals are going to work better. You really don't have to go to Harvard or the Wharton School of Economics to understand all that takes to move the stock market. It's pretty simple. It was written by another Williams, Hank Williams Jr. He's got a great song called Country Boy Can Survive. And that song's got this great line in it. He says, interest is up, stock market's down, you only get mugged when you go downtown. That's all you have to know about economics. Interest is up, stock market's down, social unrest, you'll get mugged going downtown. By the same token, interest rates are down, stock market goes up, everybody's happy, nobody's going to pick your pocket. Well, maybe in New York City, but certainly not in Great Falls. So that's the fundamental relationship. Every stock market top that I've seen since the 60s has been preceded by higher interest rates. Not a cotton picking one of them. Didn't happen without higher interest rates, every single time. The problem is sometimes it's a 6-week lead, sometimes it's a 25-day lead, or it might be a 2-month lead. But invariably, as stock prices top out, you check, you'll see earlier interest rates started to go up. The crash of 1987, interest rates started to go up. 1999 crash, 2000, interest rates went up. Interest rates started to go down in 2002, and then the stock market rally began. So that is the fundamental setup as a short-term trader. Whether it's a longer-term trader or a short-term trader, I want to see that the stock market, that the bond market's been strong, it's been rallying, because that gives me the better setup trades to be a buyer of the S&Ps, even on a short-term basis. So when you look at the pattern in the book, you'll see things like OOPS. You also see that I like to buy and sell on certain days of the week. My experience as a trader is that not all days of the week are created equal. That the S&Ps, or that's the stock market, the Dow Jones Industrial Average, S&P 500, or the Dow Jones 30, there's only 30 stocks in the Dow Jones. It's still a pretty good representative average, though, because they're such large cap stocks. Tend to rally the most. The best days to be a buyer are Mondays and late Tuesdays. The days that tend to be the days where the markets sell off the most in the S&Ps tend to be Wednesdays, tend to be a market high, and a little bit on Fridays. Those are the sell days. Wednesday, Thursday, Friday. It's almost like the market goes up Monday, Tuesday, flat. This is Monday, Tuesday, Wednesday. It comes down Thursday, and Friday it may go down or come back up. But it's definitely a clear midweek. We rally, hit the middle of the week, and start to pull back in the marketplace. So I can also be day of the week specific as a short-term trader. I want to look at the fundamental condition of the bond market. I want to see if my day of the week is correct. I want to be a buyer. Like today is a Friday. This is taped on a Friday. I'm looking to be a buyer now because Mondays rolled around. Now, why could it be Mondays are so strong? A friend of mine has written some very good books on money management. Ralph Vince has an interesting point. Ralph was managing money in the Arab states, in Abu Dhabi, I believe, or Dubai. And he said, it's really interesting, Larry. He said, all the money that's there in the building where he was, which is gargantuan amounts of money. He tells the story of going down into the basement of this building, which is a room, sound to me as Ralph represents, maybe like 30 feet wide and maybe 60 feet long, filled full of gold bars. Filled stacks of them like that. He said, it looks like kids have been playing down there. Some are just, in a nice stack, and some look like people are playing dominoes or something with them. But there's that much wealth there. The Muslim religion is really a very powerful religion, and that people follow it, adhere to it strictly, and they don't do any business on Friday. In Ralph's building, he said a lot of the guys wouldn't even have stops in the marketplace, or they pull all their position out late Thursday, because their holy day is our Friday. Then they come back in on our Monday. And that may be why we've seen more Mondays tend to be rallying, because as hot money comes back into the markets on Monday, the OPEC nation money comes back in on Monday, pulls out sometime on Thursday, comes back in on Monday. And I was really surprised when he said this one guy, a very large trader, didn't have stops on Thursday. I'd like to think I'm religious, but I'm not that religious. I'm still going to have stops in my positions. But that may be one reason why we've seen this Monday phenomenon in the marketplace. But definitely Mondays, Tuesdays tend to be rally days in the market. Even going back to the low in October 1966 came Monday afternoon and Tuesday. Most lows come on Mondays and Tuesdays. Significant lows come early in the week, and then the market reverses and goes to the upside. Another condition you'll read about in your manual is also that we have something called option expiration. The S&Ps, there are options on these markets, and they expire once a month and on the third Thursday. And there's been a distinct tendency for the market to rally for the week leading into option expiration. If you buy, the rules are in your book, but just go over them a little bit for you. If you buy on Friday prior to option expiration, that's like 1 week out, if you buy on that Friday and get out on the first profitable close, the odds are way in your favor for a rally to take place, especially in a bull market. You'll see that happens over and over again. We got a nice, strong tendency for a rally coming into option expiration. So you want to pay attention to that. Again, that's an underpinning of how the markets work. Another thing that will happen from time to time, the S&P futures contract will sell for less than cash. That's an unusual event. If the market's been coming down and the S&P, the price of the S&P 500 is below cash, it probably means we're going to rally, because futures have to catch up to cash. But it works best if the market's been coming down. So there's another internals of how the markets work to set up a potential buy signal in the marketplace. If you look at those patterns in the book, you'll see that we're talking about the fake-out pattern as well. I'll review that one more time so you see what that is on both the upside and the downside, because there's some patterns in there for you. This is the fake-out where I like to be a seller. It looks like the market has made a lower low, lower high, but it's come back and rallied. The books call that a CPR, critical path, hook day, Joe Ross hook day, Cambridge hook day. Well, I like to be a seller there tomorrow, especially if bonds are in a downtrend. Bonds are in a downtrend, higher interest rates. So I do a fundamental setup, bonds are coming down, and I have a technical setup based on emotions. Oh, the market should rally. If it doesn't, then I want to sell short. This would be my buy signal, where I have the fake-out pattern, higher high, higher low, lower close. If we get back to that point tomorrow, especially if bonds have been an uptrend, that's how I want to be a buyer. So when you look at those patterns, I know they're a little confusing. You look at the patterns in the book there. But you'll see what I'm getting at are these patterns of how the market reacts, the condition of the bond market, what it sets up to do in the trades, and then some specific days of the week. You also should point out that the S&Ps tend to rally the first couple of days of the month and the last day of the month. That tends to be the strongest rally point in the market. Also, some first trading days of the month have been pretty good trading days to be a buyer of the S&Ps. They tend to rally the first trading day of December most of the time. The first trading day of June has been a good rally point as well. And there are also some seasonal tendencies around the holidays of the year. You should pay some attention to those. But those are the short-term minutia viewpoints. Most of you, I hope, will start on a longer-term viewpoint, realizing eventually you may become a short-term trader. That was the evolution that I took. But I want you to start as I did, looking at setups, understanding markets move for reasons. Once we can identify a setup condition, then we bring in the technical aspect of the market, maybe a channel breakout, whatever entry technique you have, a trend line breakout, and look for a seasonal tendency to confirm that trade. Get into the market, buying on a stop. The market proves itself by rallying to your point, having a protected stop below the market, a target above the market. And since we don't always go to target, then a trailing stop underneath the market, which could be that turtle trailing stop. And then win, lose, or draw, you're protected here. If you've got some money, you're going to continue going up with that money until you hit your profit, or it pulls back, you're stopped out, and you take a profit. Then the hardest thing to do as a trader, take your hands and sit on them, look for another trade. Everybody rushes in too soon to the next trade. So I want you to diligently look through until you find the ideal setup markets. Those are the markets to trade. I can't tell you, oh, trade just cattle, trade just wheat. Trade the markets that are the most set up, and I think that's how you find the most success in commodity trading. Remember, if you do have questions, please feel free to email me at larrywms@att.net, or you can fax me at 858-259-1331 with your questions. Email works best in this day and age, and I'll get back to you as soon as I possibly can. I wish all of you good luck and good trading.